Don't believe the headlines celebrating 10% credit cards and 6% mortgages. Don't believe the hype on lower interest rates. And definitely don't believe anyone who tells you this is a victory for the American consumer. What you're witnessing right now in January 2026 is the most dangerous experiment in American monetary policy since Richard Nixon took us off the gold standard. The President of the United States has declared war on the price of money itself. And when governments start manipulating the cost of credit for political gain, history teaches us one brutal lesson. Somebody always pays. Usually it's you and me. Stock prices no longer reflect corporate earnings. House prices no longer reflect supply and demand. Interest rates no longer reflect risk. Everything, and I mean everything, now reflects one thing only: the president's desire to win the 2026 midterm elections. Welcome to the era of political money. Welcome to the Great Repricing. And if you don't understand what's happening, you're about to get wiped out. Let me paint you a picture of what's happening in Washington right now. On one side, you have President Donald Trump, fresh off his 2024 victory, staring down the barrel of the 2026 midterms. His entire political survival depends on one thing: making Americans feel like life is more affordable. Credit card debt has hit $1.23 trillion. The average APR is 21%. Mortgage rates were hovering at 7%. His voters are angry. On the other side, you have Jerome Powell and the Federal Reserve, an institution designed since 1913 to be independent from political pressure. The whole point of the Fed is to make unpopular decisions, to raise rates when inflation runs hot, even if it costs the president an election. That firewall, it's burning. On January 15th, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve. The stated reason? Cost overruns in the renovation of the Eckles Building, the Fed's headquarters. The real reason? Everyone in Washington knows it's a pretext. It's the legal groundwork to remove Jerome Powell for cause before his term expires in May. Here's what you need to understand. Under the Federal Reserve Act, the president can only fire a Fed chair for inefficiency, neglect of duty, or malfeasance. Policy disagreement doesn't count. But if you can prove something, anything, that smells like misconduct, you've got your opening. This isn't speculation. This is the playbook. The markets understood immediately. Within 48 hours of the DOJ announcement, gold blew past $4,600 an ounce, a record. The dollar weakened against the euro and yen. And bond traders, they started selling treasuries. Not because they thought inflation was coming, because they thought the Fed would be forced to let it come. This is what analysts call the sell America trade. It's what happens when global investors decide that U.S. assets now carry a political risk premium. Let me say that again. Political risk premium, a term we used to reserve for Turkey, Argentina, Venezuela. Now it applies to the United States of America. On January 20th, 2026, exactly 1 year after his second inauguration, President Trump's credit card rate cap takes effect. The number is simple, 10%. No credit card in America can charge more than that. It sounds beautiful, doesn't it? A victory for the little guy against greedy Wall Street banks charging 25, 30% interest. Let me show you why it's a trap. Here's how credit card pricing actually works. The base cost of funds for a bank is tied to the prime rate. Right now, that's 6.75%. A 10% cap leaves exactly 3.25 percentage points of margin. That margin has to cover credit losses. For prime borrowers, maybe 2 to 3%. For subprime borrowers with FICO scores below 660, default rates can exceed 10%. Then there's operating costs. Customer service, fraud detection, transaction processing, another 2 to 3%. Banks also have to hold reserves against these loans. And those airline miles and cashback points, they're subsidized by interest income. Do the math. A 10% cap doesn't work. It's not even close. The American Bankers Association ran the numbers. Under a 10% cap, between 82 and 88% of all credit card accounts become unprofitable. Not marginally unprofitable, deeply, existentially unprofitable. What do banks do when an account costs them money? They close it. Here's the part that keeps me up at night. The 47 million Americans with subprime credit scores, FICO below 660, they're not going to stop needing credit. When your car breaks down and you need $800 for repairs, you don't have the luxury of waiting 6 months to save up. So where do they go? Payday lenders. Effective APR, 300 to 400%. Pawn shops. Title loans that put your car at risk. And in the worst cases, illegal loan sharks. The cruel irony is devastating. A policy designed to protect consumers from 25% interest rates will push millions of them into 400% interest rates, or worse, into the hands of people who break kneecaps instead of charging late fees. Dr. Samuel Gregg at the American Institute for Economic Research called it perfectly. We're creating credit deserts for the people who need credit most. And it's not just Wall Street banks. America's credit unions, member-owned cooperatives that serve underserved communities, they've come out swinging against this policy. In a letter to the president, they called it devastating. These aren't JP Morgan executives protecting bonuses. These are community institutions warning that they'll have to stop lending to their own members. Oh, and those airline miles you've been collecting? Those 2% cashback cards? Gone. The rewards ecosystem is funded by the cross-subsidy from borrowers paying high interest. When that interest disappears, so do your points. Every free flight, every hotel upgrade, it's been paid for by someone carrying a balance at 24% APR. Kill that revenue stream, and the entire system collapses. Now let's talk about housing. On January 8th, 2026, President Trump directed the Federal Housing Finance Agency to order Fannie Mae and Freddie Mac to spend $200 billion of their retained earnings buying mortgage-backed securities. The goal is simple: flood the market with buy-side demand, drive up bond prices, and push mortgage rates below 6%. It worked for about a week. Rates dipped below 6% for the first time in 3 years. Headlines celebrated. The president took a victory lap. But here's what those headlines didn't tell you. Fannie Mae's net worth as of Q3 2025, $105.5 billion. Freddie Mac's is smaller. Combined, these institutions, which backstop the entire American housing finance system, have roughly $170 to $180 billion in capital reserves. The president just ordered them to spend $200 billion. Let that sink in. He's spending more than they have. Since the 2008 financial crisis, Fannie and Freddie have been operating under strict capital requirements. The whole point was to build up a safety buffer so that if housing prices crash, like they did in 2008, taxpayers wouldn't have to bail them out again. That buffer, it's being burned to buy votes in a midterm election. There's another casualty here. For years, conservative economists have pushed to privatize Fannie and Freddie, to get them out of government conservatorship and into the private market. That dream is now dead. No private investor will put capital into institutions where the White House can commandeer their reserves on a whim. But here's the real trap. Mortgage rates affect demand. When rates drop, more people can afford to buy. But what about supply? The U.S. housing market has a chronic shortage of inventory. We're millions of units short. And there's this phenomenon economists call the lock-in effect. Homeowners who bought in 2020 and 2021 with 3% mortgages aren't selling. Why would they? Trade a 3% mortgage for a 6% one? No chance. So when you inject $200 billion of demand into a market with fixed supply, what happens? Prices go up. That's Econ 101. The affordability benefit of lower rates gets eaten by higher prices. You're not helping first-time buyers. You're helping existing homeowners get richer while pricing the next generation out entirely. Redfin economists estimate the rate drop could be 1/4 to 0.5%. The price increase, potentially much larger. It's a shell game. The administration gets the headline, rates below 6%, while the actual cost of buying a home continues to climb. Now let's zoom out and talk about what happens when interest rates become a political variable. We're at roughly 3% inflation right now. The Fed's target is 2%. Not catastrophic, but sticky. The textbook response is to keep rates elevated until inflation cools. But what if the president forces the Fed to cut? What if, through legal pressure and public attacks, he gets his wish for cheap money? Here's what cheap money does. It keeps zombie companies alive. These are firms that can only survive because their debt servicing costs are artificially low. They're not creating value, they're not innovating, they're just existing, consuming capital that should flow to productive enterprises. In a healthy economy, when rates rise, weak companies fail. Resources get reallocated to stronger players. It's painful, but it's how capitalism renews itself. When you suppress rates for political reasons, you freeze this process. The zombies keep walking, the bubbles keep inflating, and when the correction finally comes, and it always comes, it's catastrophic instead of manageable. This is exactly what happened in the 1970s. President Nixon pressured Fed Chair Arthur Burns to keep rates low ahead of the 1972 election. Burns complied. Inflation exploded. It took Paul Volcker and a brutal recession with 20% interest rates to finally kill it. We're walking the same path. The faces are different, the dynamics are identical. So what does 2026 actually look like? Let me describe the architecture that's emerging. Financial repression. It's a term economists use to describe a specific government strategy. Keep interest rates below the rate of inflation. Force savers to accept negative real returns. Effectively, it's a hidden tax on anyone holding cash or bonds. Right now, high-yield savings accounts are projected to fall to around 3.7% in 2026. If inflation stays at 3% or rises due to tariffs and spending, your real return is near zero, maybe negative. What does that force you to do? Either watch your savings erode or chase yield in riskier assets, stocks, crypto, real estate, assets that are already inflated by the same cheap money policies. And here's the cynical part. This is good for the government. The U.S. has $34 trillion in debt. If real interest rates go negative, that debt becomes easier to manage. You're paying it down through inflation. The holders of that debt, pension funds, retirees, foreign governments, are the ones taking the haircut. This is the Great Repricing. Money itself is being repriced, not by markets, by politics. So what do? How do you protect your wealth when the dollar itself becomes a political tool? I'm not a financial advisor. I can't tell you what to buy, but I can tell you how to think. First, understand that cash is no longer a safe haven. When rates are suppressed below inflation, holding cash is a guaranteed loss. The purchasing power melts away every year. Second, hard assets matter more. Gold hit $4,600 for a reason. Real estate, despite its problems, holds value when currency doesn't. The wealthy have always known this. Now everyone needs to. Third, diversify geographically. The Sell America trade isn't irrational. If U.S. institutional credibility is eroding, having some exposure outside the dollar makes sense. Fourth, reduce debt if you can. The 10% cap might feel like a gift if you're carrying a balance. But what happens when it expires in 2027? What happens when your 10% rate snaps back to 25%? If you're not prepared, you're trapped. We're living through a fundamental transformation of how money works in America. Price signals are being overwritten by political signals. The cost of credit, the value of homes, the stability of the currency, these are no longer determined by markets. They're determined by whoever controls the levers of power. History has a word for economies that operate this way. They're called managed economies, and they tend to end badly. The question isn't whether the mistakes of the 1970s will be repeated. The question is whether we'll learn from them before the damage becomes irreversible. I'm not optimistic, but I am prepared. You should be too.